the macro environment, we want to talk a little bit about private debt. And what is private debt? With rates being at zero or really low since 2008, we, and by that I mean the TAMIM investment team, really struggled with the idea of allocating to bonds to get our fixed income exposure. We knew that at some point we would see a situation like we did in 2022 till now, where interest rates increased dramatically, and that anyone holding a bond, being it a government bond or even a corporate bond, would face potential capital losses if they were selling those instruments. Remember, as rates go up in fixed income instruments, you see the price have the reverse effect and price goes down. So at that point in time, we actually took a step back from those types of markets, and we looked at private debt as a really interesting alternative. And we did really like what we'd seen in that space. So just something to point out before I move forward in the presentation is, and I think we'd said this again in March, is there's a lot of times where you'll see in the conversation the words either private debt or private credit. They tend to be used interchangeably. And so for the purposes of this presentation, we'll talk about private debt. Today in Australia, we think that private debt is considered to be a mainstream investment asset. And in fact, this webinar is not quite as popular as our Australian equity webinars this time around, but pretty close to it. And everybody that we come into contact with, from family offices to mums and dads, is interested in investing in private debt in some way. So what exactly is it? Effectively, private debt describes something, usually money, which is owed by one group or person to another group of people or person. Basically, it's a transaction where a lender provides a loan to a borrower. These loans are normally non-bank loans, which means that the lending party is generally not a bank. Importantly, that doesn't make the loans that we're entering into more risky. What we found that is that the banks have tended to remain outside of business lending over the last 5+ years, with much more focus on residential home loans. They tend to be more profitable for them, and their systems are set up so that they're much easier to operate. Private debt loans are just those loans that, because the banks are staying away from, we're finding that the private individuals or private groups are able to get out there and fund them at probably better rates for ourselves as investors, and something that makes a lot of sense to hold within the portfolio. So private debt tends to have a number of characteristics that make it interesting from our perspective, and obviously a strong candidate for investment or inclusion in investment portfolios. So those characteristics tend to be, firstly, that the loans are individual and unique. And as a result of that, they can be tailored to the benefit of the lender from a security of capital perspective. And security of capital is always very important to us. So this is done by the provision of collateral or security in the loan, or the provision of covenants or safeguards to the lender, or even both. Secondly, assets provided as security are generally hard assets. And in Australia, this collateral quite often tends to be property, sometimes business assets, or even business cash flows. One of the managers that we invest into, which we'll talk a little bit about later in the presentation, is actually a specialist in business cash flow lending. So loans can also be structured to sit high in the capital stack. Quite often we'll find that they're senior secured. So that means that the lenders rank before other creditors in the event of a default. And finally, the loans will quite often be accompanied by personal guarantees from borrowers. The normal downside that we do see in private debt is that the loans tend to be illiquid in nature, which means that they'll be held for a longer period of time. And they're likely not to be easy to exit from prior to defined exit periods.